My name is Libby Ross. I'm Senior Sales Client Relations Manager here at Mayar Capital. I'm delighted to be joined today by Aziz Al-Naim, our founder, portfolio manager and managing director, and by Aubrey Brocklebank, partner, head of research and deputy portfolio manager. Given recent market movements and the evolving geopolitical backdrop, we felt it was important to bring this Q&A forward ahead of the release of our quarterly letter. In Aziz's memo to partners last week, he reflected on how current events are driving market volatility, acknowledged the challenges this creates, and highlighted that we're seeing new and compelling long-term buying opportunities emerging. Today's session is very much designed to be interactive. Thank you to those who have already sent questions in advance. We'll begin with those and then open up to further questions. So please feel free to submit your questions in the chat function. So, market drawdowns and unsettling headlines are never comfortable. To start us off, how are you thinking about the current volatility in the context of the fund's long-term strategy? And what gives you most confidence that the portfolio is well positioned from here?
That's a very big question. So I think the long-term volatility in and of itself doesn't change anything. Certainly, the volatility in and of itself doesn't change anything for me in terms of how I think about the future. We've always prided ourselves on having a very long-term horizon, especially by the standards of your average public equity investor. So when we look at things, we're always looking at 3, 5+ years in terms of whether we were forecasting the underlying fundamentals of the business or just thinking about the economic conditions affecting an industry and so forth. With very few exceptions, the short term basically does not factor into our thinking. Now, the short term can be an opportunity from time to time, and volatility has been an opportunity this quarter in the sense that it has allowed us to reposition our portfolio in different ways, take advantage of opportunities that of things that have sold off, and because we've done the work before, we were able to buy efficiently and very quickly, and sell some things on days where the market was up during the quarter. So volatility is the friend of a long-term investor because it creates opportunities to buy and sell, and because it creates the necessary conditions for other investors to become emotional. It creates opportunities for assets to be mispriced. I don't know if you've got any thoughts on that.
Yeah, I think just to count on what you're saying, we need volatility. And active managers need volatility. It's the volatility of price has to be greater than the volatility of value in order for active managers to outperform. Because the value of the assets, it will change. Circumstance and macro will alter the value of a business, but generally it doesn't alter that value by a huge amount. But the price can move, by a very large amount, and we have to distinguish how much has the value of the business changed and how much has the price changed, and does that then create an opportunity for us? And as you say, we have had this volatility, and it has created opportunities that we have capitalized upon, and we believe will lead to some hopefully exceptional results over the next 5 years.
And following on from that, similar question. During periods of crisis, markets can move dramatically. How do you separate that short-term market noise to a company's long-term fundamentals?
Well, I think it's similar to what Aubrey and I were just saying. In the end, short-term noise, even fundamental short-term noise, almost doesn't matter in most cases. Now, there are some cases where it does matter. We've seen that, for example, during the pandemic, where you can have a short-term situation where it impacts the balance sheet. And so you have a very bad year, and it may not matter in terms of earnings 5 years out, but it does impact the balance sheet because the company may end up over-levering the balance sheet or getting into trouble. Or in the case of companies that we've seen, Alstom is probably one good example. It eventually created the opportunity where we ended up buying, but it was because of a short-term loss. They had to do a rights issue to fix their balance sheet because they would lose contracts if their debt rating got downgraded. So there are some situations where the short term does matter because it does impact the long term. But in most cases, volatility and noise are things to look through and take advantage of, as opposed to kind of be scared about.
I think, look, yes, we just have to do the work. This is what we're paid to do. So let's take the recent example. Oil has increased very significantly. We will look at the companies in our portfolio and the companies that we're currently looking at on our watch list. And we'll say, okay, right, so you were making 100 in revenue and 30 in profit. Your costs are going to go up from 70 to 77 because of oil price. Can you increase revenues from 100 to 107 so that you can still maintain that same profit base? And this is why we like quality businesses, because a really high quality business is going to be able to pass those costs on. Now, if it can pass those costs on and keep the profit the same, then the value remains, almost the same. If, however, they can't, if they can only increase pricing to 106, then they're going to lose profit, and that is going to impact the valuation. But, is that a big impact? Again, that's for us to assess. Or it might be that they can increase the profits, but they're going to have 1 year where they can't because of contracts. And so we go, okay, so actually the terminal value will be the same, but we're going to have to knock 7 off the valuation, and that might be 5%, 7%, 10%. Yeah, but again, it just comes back to what I'm saying. How much has the value changed compared to how much has the price changed? If the value has deteriorated by 10%, that is not an issue. If the price has dropped by 30%, because there is our opportunity.
I mean, if you look at the average company in the S&P 500 or the SCI world, and this changes from year to year, and it's different depending on market share. The volatility of the stock, so the high to low range within any 1 year, is 30 to 50% for the average company. There is no way that economically the value of a business is changing 30 to 50% within a 52-week period. What is changing is the perception of the market and its estimate of the future. And it doesn't mean that doesn't necessarily translate that you're going to be able to buy it when it's 50% up and sell it down, because you may not actually also know the actual value to that degree of certainty. But the point is, the volatility is always, as Aubrey were saying earlier, the volatility is always higher. The volatility of the price is always higher than the volatility of the underlying value of the business. And that creates opportunities to buy and sell.
How should our partners think about short periods of relative underperformance when the drivers we've discussed are macro-driven, event-driven, rather related to the businesses underneath?
Well, I mean, I'm not sure the person who asked the question what the definition of the short term, to be completely honest. If it's 1 month or 6 months or 1 year for that matter, in my opinion, performance over a 1 year period or anything less is complete noise. As much as Wall Street analysts make you want to think, most of the things are explanations after the fact, as opposed to the actual driving the news or information driving the performance of a stock. Over longer periods of time, I think. So if you look at our performance, for example, of the past 3 years, which is, we've talked about this in the last letter, and I'll touch upon it. I send my this quarter's letter end of next week. Our performance has been disappointing, at least for me, and I'm sure for many investors. It's for me, not just as the portfolio manager, but also as an investor who's got the overwhelming majority, almost all of my liquid net worth invested along your side in the fund. Now, if you look at our performance relative to pretty much every quality style fund manager, we've been within 1 or 2 percentage points of people who, like us, have previously been top quartile manager for the previous 10, 15 years. So there's been this challenge for the style of investing that we pursue over the past 3 years. Now, styles do come into and out of favor, and this has certainly been the longest and biggest kind of underperformance of the quality style of investing in at least 20 years where we have good data. But like I said, things do come into and out of favor. The one thing, though, that I would say is underperformance in and of itself doesn't mean anything unless you understand the source of that underperformance. And when you own businesses that are resilient, like the ones we own, where historically you'll see that we've had less volatility, less drawdowns in every meaningful period, underperformance on the upside is less bothersome than underperformance in the downside, I think, in my opinion. But I wouldn't look at it in any 1 week or any 1 month because, again, as I explained in my memo, you'll have short-term factors like FX or your geographic exposure that might be driving these differences. But I think it's something to always think about, at least it's something we think about in terms of assessing any individual position, and it drives our decision-making and review. So, for example, when we own something that we think should be behaving in a certain way, and the fundamentals of the business underperform, it is a point where we examine our thesis, we re-examine our analysis, and if the stock underperforms for a longer period of time, usually for us 3 years, then we basically have to re-underwrite or re-examine the position to make sure that we're not wrong, because I think over long periods of time, the market is probably right. It's in the short term, but I think the market is noise.
I mean, look, clearly it's been, a disappointing, 3 years, as you've said. But, I think sort of in reference to the question of the short term, when you have sort of market movements like this, which are sort of, let's say, related to oil price and such, you've also just got to remember that these things reverse incredibly quickly.
Oh, I've seen this morning.
Well, exactly. That's that sort of point I was coming to, that you have, a couple of bad days, and then all of a sudden, the politics change and, it flips so quickly. And so I think this is the danger of trying to time markets, that, it just, events move too quick and are too unpredictable. And I think this is why we both like the style of investing that we have, where it's long term. You look for great businesses that can outperform over the very long term, and you don't, and you have to try and then ignore the noise that comes from, the US administration, as hard and as it is to ignore some horrific things that might be being said. We need to focus on what we actually own, what their long-term prospects are, and that's usually actually fairly relevant to, to a lot that happens in the macro.
And also, just because we have opinions doesn't mean that the opinions actually impact how we invest. So you'll see me on TV every other week expressing opinions about macro things. It doesn't mean it actually factors into how we invest. It's my personal opinion, and I'm probably wrong most of the time, because most people are wrong about these things most of the time. But yeah, I mean, I'll have emotional feelings about what's happening in the Gulf right now. It doesn't mean it should impact how I invest.
Let's turn to the portfolio and how you're positioning it, the activity that's been going on. As you mentioned in your memo last week, this has been one of the busiest trading periods we've had for many years. You talked about upgrading the portfolio. What does an upgrade mean within our investment framework at Mayar? What are perhaps recent additions to businesses you've followed for a long time but now found attractive valuations? I know you won't comment on names, but perhaps you could just enlighten us a little bit more about the ideas and themes that you're most excited about.
Okay, so to answer the last question first, and then I'll hand it over to Aubrey. Yeah, I don't want to mention names today because I forget it. My view is always everyone needs to have access to information at the same time. So it'll be in the letter when it comes out in the next week. There'll be individual names and why we like them and bought them. I'll have Aubrey talk about themes in a second. But I think when I talk about upgrading the portfolio, it is in situations, there's always a trade-off between what you want to own in the long term and how much you want to pay for it. This is why we talk about owning great businesses, great companies, and great value. And sometimes great value is not present. And that means we either hold cash or we might own something that may be of a lesser quality than option number A, but is the valuation is so attractive that it's worth holding or worth buying at a moment in time. And when you have volatility and the price movement changes, whether it's because of war, macro events, industry-specific events, or whatever it might be, even if it's idiosyncratic to the company, it may bring down the price of something that you like, that you think is of better quality than otherwise. And often it's in these situations that it's time to kind of rejig the portfolio in a direction that we think is better. So what happened this quarter is there are some businesses that we really like, that we've either owned in the past and sold, or owned in the past and significantly trimmed, or looked at in the past and wanted to own, but the valuation was too high. They've come down in price this quarter, and that's given us the opportunity to deploy some of the cash that we have. So you'll see when it comes out, I mean, you probably have seen that in the fact sheets, cash has come down, but also we've sold some of the things and redeployed that capital into some of these ideas, and more details will be in letter. But Aubrey, do you want to maybe touch upon some kind of big themes maybe?
Yeah, so I think one of the things that has really excited all of us is the sell-off in software. Now, is AI going to disrupt software? Yes. I mean, absolutely. We know that. We know that if there are fewer lawyers, there are going to be fewer seats that legal software can sell to. We know that some software is going to be easily replaced. However, what we've seen happen, and we think it's probably because of ETF selling, and that because ETFs are now such a large percentage of volume, that when people start selling these things, everything gets sold off indiscriminately. And software is not all the same. ERP software, transaction-based software, these are things which are incredibly difficult to replicate with AI and to do so safely. I mean, when a company installs ERP software, they can spend hundreds of millions of pounds and take years to do this. I do not think that someone is going to vibe code ERP software, not on an industrial scale. Maybe a small firm of maybe our size, maybe we could build something. I mean, I know my brother has built some accountancy software and CRM software for his firm, but his firm actually happens to be an AI tech firm. So, if anyone's going to, it's him. Would we do it? Well, maybe, but probably not, because actually that's going to take up a lot of our time. And you sort of think, well, for $600 a year to replace accounting software that we know works incredibly well with something that maybe I built as a side project. Yeah, I don't think you're going to go with that, are you?
No, I think this is the risk and reward doesn't work. And my favorite example of that is open source. I mean, open source software has existed for free for 20 years. And yet companies have been paying Red Hat and other people to actually give them customized open source software, or more importantly, support on an ongoing basis and implementation. So there's more to software than just the code.
And then, one of the things that I always sort of bring to mind is, one of my sort of big investing mistakes 12, 14 years ago, how long it was, I don't know. I was at a hedge fund and we were short Sage, the accounting software provider, because we had seen all these new competitors come up. There was companies from zero that was growing at silly numbers at the time, but there was also free software that was also coming out and sort of seemed to be gaining traction. They all had great markets. Now Zero did grow just as we thought it would, but it didn't actually disrupt Sage. Sage still grew at 6% organically every year from then to today. Now, I sort of look at that and go, okay, so this is a legacy software firm that was in trouble back then. I didn't like it then, and for good reason. We did lots of channel checks. People did not like the software. People loved all the new incumbents. But disruption can just take such a long time, even when it does happen. So I sort of think, even if we're wrong on some of these software products, some of these software names that we are investing in, even if they do get disrupted, the time frame is likely to be so much longer that the impact on them will not be noticeable for many, many, many years. And hopefully we'll be able to see that before it happens. So, I mean, as I say, some of these names that we have, we are very confident they can't be disrupted. Some, there is a bit of risk, but we think that the risk is very much mitigated by the fact that we will have visibility into that, and that actually, because of consumer behavior, these will actually continue to outperform for a very long time. And we are buying these at roughly a normalized 10 times earnings or less. So, I mean, and when we normalize it, we have to look at, well, what would they spend in the normal state? Well, they wouldn't actually spend all this money on sales and marketing if they were growing only at 6%. If you're growing at 20%, you're spending a lot of money on sales and marketing. If you decide to stop that spend and grow at 6%, which is still pretty good, you'd make a huge amount more profit. So that's sort of what we mean by normalization in this context. And if we're buying these at 10 times, I think there is such a good chance of making a lot of money here. I mean, we are really excited. It is like when we got to buy the likes of Google and Microsoft at 10 times, and we just look how well that panned out.
Just considering all of this volatility, when you look back historically, when have been some of the most rewarding times to deploy additional capital into the fund? And how does this moment compare against them?
Well, in any investment, at least that's my opinion, maybe there's something wrong with my head. If we make an investment and I'm not feeling uncomfortable, I worry. And the reason I say this is that I strongly believe that if everything looks good at the time that you're investing, you're probably missing something or you're overpaying. But there's no way that something is undervalued and everything looks great. That's not the way markets operate. So that's kind of on an individual basis. In terms of investing in the fund, I've just invested earlier this week in the fund, and I usually do every quarter anyway, but I did do a bit more this month because I've just found that over time, whenever you've got a drawdown of say 10%, then it's a good opportunity to be adding. Whenever you have a drawdown of 20% in equities, it's a good opportunity to really kind of go all in. And I've done this now for 25 years. And basically, when people talk about buying the dip of 5% or 7% is not buying the dip. Buying the dip is when the market is down 20 and you're really buying. And there are very, very few times when you regret buying at a 20% drawdown. Now, that being said, there are many times where you buy after a 20% drawdown and the market goes down another 20%. But that's not my test. My test is after I buy and I close my eyes and open my eyes 5 years later, am I happy about my purchase or not? And there's almost no time when that has been the case, where if you buy after a 20% drawdown 5 years out, the chances are you're going to be happy about your purchase. And in some cases, you might want to say, you know what, I'll buy a little bit after 10%, a little bit more after 20%, and keep adding. But if you get too greedy and try to really kind of pick the bottom, often you miss your chance to buy. And that's been my kind of opinion, whether it's an individual stock or a fund. And if you get too greedy, you miss out on the upside more often than not.
I don't think there's really anything to add to that.
Yeah.
We've got some questions coming in. One of the questions relates to currency. The US dollar lost value in 2025, and they say the downfall most probably continue. Given that investments that may have valued in US dollars, the true rate of return may not be exactly what is reported. We would therefore prefer needs to be adjusted to take into consideration the weakening of the dollar and the losses against other currencies. Please comment.
Well, I don't know what's going to happen to the dollar the rest of this year, or for that matter, in the next 3 to 5 years. And I think that's why we've always believed in having a globally diversified portfolio of underlying assets. So that's kind of in terms of what we own in the fund, because we don't know whether the US dollar is going to do better in the next 5 years or euro or whatever it might be. I don't think anyone knows, to be completely honest. Now that's kind of on the underlying assets. I think the question that we got may relate to the reporting effect of us reporting in dollars, not just the underlying assets. And it's true that 2025, the dollar weakened and that kind of helped our performance and relative to other currencies. But the year before that, it was the opposite. And the dollar strengthened and it hurt us. And then in 2022, the dollar strengthened and hurt us. So they've been up and down. If you look, I mean, this is the benefit of sending a question before the meeting. So thank you for sending this before, because I was able to look at the numbers. And over the past 5 years, it's been basically a wash. So there are periods where the dollar helped us and periods where the dollar hurt us, but on average, it's been 3 percentage points plus or minus in terms of difference. If we look at the performance since inception, the fact that we report in dollar actually hurt us a lot. So our performance since inception in euros and in sterling would have been about almost 80% higher had we been reporting in sterling or euro versus the dollar. That's about 1.6% higher return had we reported in those currencies. In yen, it would have been 2.5 times higher. So about 300 percentage points higher had we been recording in yen. And even in franc, which is historically a deflationary, stronger currency, our performance would have been impacted by only about 20 percentage points. So it's about 1%, or no, sorry, 0.5% per annum in difference. So since inception, the reporting in dollars has hurt us, if not helped us, by a long margin. And when you look at our performance in UK databases, optically it looks better because it's in sterling. In the end, I don't think the reporting currency matters. What matters is what is it that you own. And as long as you own assets of high quality and they're growing over time and they're growing in real term and the underlying assets can pass on inflation to their customers because they have pricing power because they're high quality businesses, then your purchasing power as an investor is going to be protected, and it means that you are earning a real return over time. So since inception, depending on doesn't matter which currency you look at, but roughly speaking, if inflation has been about 2% over that period, and we've managed to grow at about six, depending on the currency, 6.5 percentage points of real returns above inflation. So the earning power of someone who invested in the one has grown in real terms by 6.5% per annum. Historically, equities have done between 5 and 6%, depending on the period and the geography. So as long as we're doing that, I'm happy about it. Like I said, the past 3 years especially have been disappointing in terms of absolute return, and we've talked about the specific years. And I think we will have a recovery, if only because I think quality as a factor has been just under so much pressure. They're going to have some mean reversion over the next 3-5 years. And I think the absolute return that we have is going to get higher. But in the end, it's relative to inflation that matters. So if we ended up in an environment where inflation is 5%, then making the return that we've made would not have been satisfactory, I think. So I think in the end, I want to be able to make at least 5 percentage points ahead of inflation over the long term to be happy as an investor. And so the inflationary environment matters a lot, not the actual currency that we reported. You have anything to add?
Well, I'd just say that the only importance of reporting currency from an investor's point of view is what is the currency that you live in. Yeah, do you live in a US dollar based currency or US dollar pegged currency? In which case you want to see it in dollars. Look, my life is in GBP, So, I like to look at the fund in GBP every now and again, especially when, Best Invest, finally open, put the fund on their platform, and I can put, all my pension assets in there, or most of them.
Can I get that in writing?
Well, I've said it on the camera, so yeah. I mean, I'm thinking sort of 80-90%. I'm still going to keep my punting, allocation to, the sort of moonshot stocks that are sort of too small for the funds. But but I'll be looking at it in GBP because it'll be a GBP share class, and that's what my life is based in. That's the only.
Yeah.
It makes more sense to me to understand it in GBP, and that's the only reason.
Incidentally, we do have a GBP and Euro share class, and people are welcome to switch if it doesn't really make a difference other than the reporting. And we've seen it, for example, in the March number, because the dollar kind of strengthened significantly in March. There was this is a 2 percentage points almost difference, where the GBP share class outperformed the US dollar by 2 percentage points. But that's just, I mean, it's an artificial construct, is what I was trying to say.
And with that, I would like to invite everybody to submit any questions you might have. We have a few coming through. Given the current geopolitical backdrop, including developments in the Middle East, how are you thinking about capital allocation towards European photonics and semiconductor supply chain names tied to AI data centers? Are you seeing any valuation dislocations or opportunities to build exposure? So that's in European photonics and semiconductor supply chains.
Not yet. Not yet is the question. They've not come down in price enough. There have been some of the areas that have held up a lot. Some of the other European names that we like have come down, and we've deployed into them. You will see when the letter comes out. We've been very active this month. I mean, if you look at our historic portfolio turnover, I think our average has been over any 1 year. It's been about 20 percentage points per annum. And then in any one quarter, I think it's been about 7 to 10% in any one quarter. And this quarter, our portfolio turnover was over 25%. So massive, massive difference compared to before. And that's in capital terms. But like we were saying earlier, we've been deploying carefully, not all at once. And so actually, in terms of the number of names that we've added more than half a dozen names this quarter. So quite an active quarter in terms of new investment names, and also names that we've either trimmed or sold out of. So, and that continued into April as well. So this volatility we have definitely taken advantage of, and we're keeping an eye on, as we always do, of all the names that are on the bench or things that we like. But specifically on things that I assume the question is about things like ASML and Zeiss on the lenses and so forth. They haven't come down in price yet, but you never know. They're definitely on the radar.
Well, they're on the radar, but I mean, we are still very nervous about this AI infrastructure build out. I mean, people are now saying that the cumulative spend over the next 5 to 10 years is going to be 10 trillion. I mean, again, I know we've been through this maths before, but I'd like to just reiterate how big that is and what is required. 10 trillion means you need 1 trillion to make a 10% cost of capital. You're going to have 2 trillion of EBITDA for that. So you're going to have 3 trillion of required EBITDA. If you get a 30% margin, we're going back to 10 trillion of revenue. 10 trillion of revenue, that is twice the global IT spend. Now, if I think about what we would require to, let's say, well, it wouldn't be us because we're too small, but if we were a big firm and employed 100 analysts, what would it take to replace an analyst, who is paid 100 grand? How much would we have to pay? Would we be willing to pay for AI that would do that? Maybe 50 grand? Maybe 25 grand? We're not going to pay 100 grand to replace 100 grand analysts. That's absolutely certain. It would have to be a lot less. So the cost savings that you're going to have to make are going to be so much greater than that 10 trillion. And let's face it, the majority of the value that AI creates is cost savings rather than revenue enhancement. So
At least in the short term,
and yeah,
in the next few years, yeah.
so I would say that you are going to have to make so much cost saving in order to justify this 10 trillion of spend that it just almost cannot happen. And even if it were likely, governments are actually going to have to come in and intervene, because what's at global GDP, something like 100 trillion. If you are then saying, well, we're going to save 20 trillion of costs, that's 20 trillion of salaries from lawyers, accountants, bankers, people who pay a lot of taxes, spend a lot. I mean, we would be talking about something so catastrophic. Well, I mean, a lot of us have read the Citrini report. This cannot be allowed to happen, even if it were to happen. So I think we're skeptical of that 10 trillion being spent. And when people start to pull the plug, that's when I think we're going to see a lot of these names, these beneficiaries, really sell off.
Yeah, and I think the other thing to remind everyone is we run a liquid portfolio, and we're assessing these things in real time. So just because we say something today doesn't mean that we're not going to change our opinion.
Yeah.
If circumstances change tomorrow, or for that matter, 5 minutes after we leave the meeting room, we'll change our mind. And we've changed our minds on many things before, and we'll continue to change our minds on things. And this is one of the benefits of owning publicly listed liquid names. I'm not saying that we like to trade all the time, but having the option to change our mind in light of new information or new analysis is a huge, huge benefit to being equity investors, and that we are not locked into any one stock, opinion, industry view for the next 10 years. If circumstances change, we'll change our mind, and we're always out on the lookout for opportunities to make money.
Question, global change, world is not going to be the same post Iran war. Traditional alliances may be challenged or even dismantled, and new alliances will appear. If what analysts are contemplating materializes, we may see the Asian economies that have shown more resilience to the economic pressure of the trade war than the current Iran war emerging to fill the void and resume a prominent role. How is that going to impact the way you think, select, and manage your investment?
I think the short answer is we don't know. We don't know what's going to happen to the world. We don't know when the war is going to end. I'm not going to say if, because at some point, sorry, not the world, sorry, the war. maybe it's a Freudian slip and the world is going to end. I don't know. Like I said, I mean, referencing what I just said just a minute ago, we're going to have to assess things as we go and see how the world changes. I mean, one of the most important things that we know has been a driver is the kind of petrodollar policy, for example. So the deal that the US did with the Gulf states in the early 70s, especially with Saudi, to sell oil in US dollars. And there have been many people who've tried to disrupt that and have not been able to, until relatively recently, when we started seeing people like Iran selling oil in yuan, Venezuela, incidentally, until recently. And one day after the change in Venezuelan administration, they went back to selling in dollars. So that definitely matters a lot in terms of the position of the dollar as a reserve currency, as it's important for global trade. In the short term, depending on the outcome of the war, how long energy prices remain elevated, it may not be the case that actually Asia or Europe benefits. It might be the opposite. I mean, it might be that they hurt because they're net importers of energy, definitely China, Korea, and Japan. And if those three economies in Asia don't do well, nothing else in Asia is going to do well. But I think the short answer is we'll wait and see. But we're always thinking about these difficult questions and how they impact the businesses that we own. It's very risky to make grand predictions about the world changing in a way that we haven't seen in a very long time. But at the same time, history also tells us that every now and then there is an event that does happen, that does change the trajectory of history. And certainly what we're seeing right now is the type of thing that normally would lead or could lead to those kinds of changes. We'll wait and see. I'm not going to try and make a prediction about that because the odds are I'm going to be wrong about it, but we'll react to it.
So, I mean, what could happen, as you mentioned with Asia, we know they're going through energy rationing, so that might be a negative there. But, you know, I think maybe the question is getting at, let's say, de-dollarization. And that is something we've talked about, you and I have talked about for quite a while now. And not as something that we seriously think is going to happen rapidly and quickly, but as something that could be a gradual progression. And that's probably been part of the thinking as to why we are massively underweight, US, or at least have been in the past. Well, actually, that's not wise. The wise because Europe has just got many better opportunities, but it certainly made feel better on that.
Well, I don't think it's the reason why we're underweight, but the reason why we want to be diversified.
Yes, no, exactly. That's a better way of saying it. Is there a possibility that we see new alliances, that we see further de-dollarization? Well, yeah. I mean, I am reminded of the Suez crisis. Actually, I think it's my great-great-grandfather was a director on that, sort of a rather fateful time. But the trouble was Britain was not able to protect it, and by showing the world that the empire could not protect the Suez Canal, that sort of eroded a huge amount of confidence in the empire, the British Empire, and that is sort of, I think, what many historians will say is one of the sort of big nails in the coffin. And I think we could see something similar with America here, that it wouldn't be this alone, but if they cannot protect the Strait of Hormuz, and if oil does not flow and America just leaves it, that would be effectively a defeat, in this war. And Americans' military presence and strength would be massively questioned, and their value to allies, and their value to NATO becomes highly questionable. So again, does the dollar retain the same value after that? I don't know that. But again, these are hypotheses that, do they really impact our portfolio? Well, they'll have an impact on short-term pricing, but look at Croda, wonderful business that makes the active ingredients for, let's say, beauty creams or shampoos. The peptides they have for, sort of Boots beauty cream, actually, that's one of the best beauty creams out there, apparently, according to the science. Are they going to still sell as much? Well, yeah, because I'm still going to wash my hair. Well, maybe
I still wash my hair.
Well, actually, maybe in 10 years, I won't be, but Libby, you will. And I'm sure you won't have any need of the anti-wrinkle cream, but there are plenty of other people who will just keep buying this stuff, and they'll keep buying. And Croda, because of their unique intellectual property and their unique development and the science, they're still going to be able to raise prices. So. What will happen to Croda in the short term? I don't know, because you're going to have volatility of input prices, which will impact earnings in the short term. But long term, I'm pretty comfortable that they are going to be a bigger, better, stronger business in the future.
And again, don't want to beat a dead horse, but we don't need to press a button now and commit to any decision for the next 20 years. We're not buying private companies, getting stuck with them for a very long period of time. This is one of the, there are very few benefits of liquidity. Definitely this is one of the few ones, because a lot of them are negative. But I think this is one of the benefits, that when we go into something, we are going in with the assumption that we're going to own it for basically forever, or at least for a very, very long period of time. But just because we have the intention of doing it at the time of the purchase doesn't mean that we will not change our mind at some point in the end. And we've done that. There are things that, I think there are things that we've sold a couple of months later because circumstances change or we change our opinion or whatever it might be. And there are things obviously that we've owned for 20 years. So I think, again, one of the benefits of investing as liquid assets is you can change your mind as circumstances change.
The next question, we're moving into the world of private credit here. How do you assess the evolving risks in the private credit market, particularly in light of rapid growth, reduced transparency, and potential liquidity mismatches? Do you have a view on private credit?
I mean, this is kind of almost ties very neatly to the last thing I said about liquidity. It's really funny. I mean, investors are a funny bunch, and us included. We're all subject to the same biases and like the illiquidity of private credit and it's obviously colored the private equity in more generally. The illiquidity has essentially been a feature, not a bug, for most of its existence. And the reason is basically you can lend to these companies and have a longer period of investment horizon because you don't have a regulator, a depositor behind you who's going to ask for their money overnight. And from an investor's point of view, whether private equity or private credit, the lack of a daily mark to market has also been a feature, not a bug, in the sense that the economy can do this and the equity market can do that and rates can do that. And you own something that it doesn't change in price or doesn't change much. So you feel better about yourself at the end of the quarter, at the end of the year, because you haven't had a lot of volatility in your portfolio.
You have had the same volatility of value.
Yes,
but
you just
have
exactly. You just don't know it. What I would give up to be able to not mark to market your portfolio and report based on what I think the companies are worth. But then now suddenly the private credit investors are demanding their money, and we've seen a lot of funds deal with it differently. We've seen Blackstone basically arm twist their partners to when they had more than most private credit funds allow you to redeem 5% per quarter. So that's the context. And then now we're seeing private credit funds, both the publicly listed ones and the private ones, getting way more than that number in terms of redemption requests. Now, within the letter of the agreements, the private credit manager can say, sorry, guys, this is what we've all agreed on. You will not get more than 5%. But we've seen them react in different ways because investors are panicking. And every time this happens, the next quarter, more people will want to redeem. So Blackstone first came out and they basically arm twisted their partners and they took money out of their pocket and redeemed the excess. I think it was 2 or 3 percentage points or thereabout at par. And good on them for doing that. I think it's basically an investment in their reputation, not necessarily in their fiduciary responsibility to investors, but in their ability to raise money in the future. So I think it's a commercial decision that they've basically made as an organization. And we've seen people like Blue Owl where they couldn't do it, and we've seen what's his name? Is it Saba? Weinstein, I can't remember his first name, a hedge fund manager out of New York, and he's put a 65 cents on the dollar bid on these private credit funds, which I think actually the bid comes into place or expires in 2 weeks' time. Is this sometime later this month? So definitely watch the space because it'll tell you how much people are willing to sell what are these supposed safe assets are worth. So we're seeing an acceleration of the trend where people are redeeming more than 5% and companies trying to struggle with it. I don't think that there is a systemic risk from what's happening in private credit, as far as I can tell. Obviously, the banks do lend to these funds, but they're lending against an equity in the fund. So, I mean, famous last words. That from what I've seen so far, I'm not worried in terms kind of like this creating a new financial crisis or anything like that. I think it brings into question some of the conflicts of interest that we've seen, where the same organization is buying a company and then the private credit fund is lending to them to buy a company on the private equity fund, and some of the quality that has deteriorated over time. And a lot of these deals were done a few years ago, especially kind of post-COVID period, where people were a bit wacky and doing things that they really shouldn't be doing as credit investors. It's definitely an interesting space to keep an eye on. I don't think it matters for our portfolio. I suspect it doesn't really matter in terms of the global economy, unless we're wrong about what's happening. One of the problems, to be honest, is there isn't a lot of transparency about what's happening, who owns what are the underlying. There are a lot of big questions about that. Even the size of the industry, we don't really know. So if we're wrong about any of these things, or if I'm wrong about any of these things from what I've observed, then the consequences could be worse. It's an interesting space to watch, and the most interesting thing is, like I said, how what was something that was meant to be a feature suddenly became a bug, and now people want liquidity, as if there isn't something where you do have liquidity, and it's called bonds.
I mean, I think you're right. It's probably not going to be systemic. You know, we're not looking at a GFC type thing. It's just, even though the numbers are huge, it's not in the same way. It's not anywhere similar, you know, to GFC. You don't have those derivatives. You don't have, you know, it tied, as you say, without equity, without backing. You know, but yeah, I think a lot of people are going to lose their shirts, and I guess the contagion that will happen is it will be more difficult to raise capital for certain industries.
Yeah.
And you know, that is always a negative. Yeah, but again, you know, that's not the sort of thing that our portfolio is going to be impacted by.
I don't think it's a tragedy if we have fewer private equity funds.
No, you know, and if it means that you don't get more tech startups or tech, you know, I mean, some of the tech.
I mean, some of it has also paid for AI infrastructure, some of the newer deals.
Yes.
So, I don't know, maybe people like Meta should have a spine and actually put the borrowing in their balance sheet if they want to do something, and not try to hide it in these kinds of deals off balance sheet.
Well, I think looking at the time, I think that brings us to the close of today's session. Aziz, Aubrey, thank you so much for sharing your perspectives. Thank you to everyone who's joined us today. We hope you found this insightful. If you have any additional questions that you didn't get to ask, please feel free to reach out to us and email us at ir@mayarcapital.com. Thank you once again for your continued trust and partnership, and we look forward to connecting with you soon.
Thank you for joining us today.
Thank you.